Derecognition of a financial asset is part of the everyday operations of all entities. Financial assets may be derecognized when the cash flows expire, such as a customer paying their account, or when the contractual rights to the cash flows are transferred. Cash flows can expire in many ways. For example, an entity could pay an invoice from their supplier. A borrower could repay their mortgage. A parent company could forgive the debt of a subsidiary. Or a contract could be cancelled. In all of these cases, the entity would derecognize a financial asset. Transferring cash flows is slightly more complex under IFRS 9. An entity could transfer a fixed amount of cash flows to another entity, or a fixed portion of the cash flows, or a fixed portion of a fixed amount of cash flows. There are two methods by which an entity can transfer a financial asset. Firstly, an entity can legally transfer the asset. In this type of transfer, an entity is only able to derecognize the financial asset when the contractual rights are transferred from one entity to the other. For example, a debtor that once paid Entity 1 is now legally required to pay Entity 2. Entity 2 pays Entity 1 a fee for this transfer, which is usually an amount less than the value of the asset transferred. The second type of transfer is where an entity simply remits all the cash flows it receives from the asset to another entity. This type of transfer does not require an adjustment to the original contract between the entity and its debtor, and so is sometimes easier to put in place. For example, Entity 1 collects money from a debtor. Entity 1 then enters into an agreement with Entity 2 to hand over all the cash it receives from the debtor in exchange for a fee which is usually less than the value of all cash flows transferred. However, IFRS 9 places a number of restrictions on whether this type of arrangement qualifies for derecognition. Entity 1 must only be obliged to transfer cash it actually receives from the debtor. Entity 1 cannot sell or pledge the contractual cash flows it receives from the debtor to anyone other than Entity 2. And Entity 1 must remit all cash flows it collects from the debtor without material delay. No matter which transfer method is used, substantially all risks and rewards incidental to ownership must be transferred. These requirements can seem very complicated to apply, so let's consider a relatively common example and apply IFRS 9 requirements. Bell Homes Pty Ltd builds houses. Currently, Bell Homes has a large number of houses to build, but it is facing some cash constraints, meaning it has plenty of receivables, but little cash. In order to boost its cash reserves, Bell Homes decides to transfer half of its receivables to a bank as allowed by IFRS 9 para 3.2.2a2. Bell Homes does this by entering into a contract with the bank to transfer all cash it receives only when it actually receives that cash, not to sell or pledge its contractual rights to the cash flows to anyone else, and it will transfer the cash as soon as it receives it from the home buyers. In exchange for the cash flows, the bank agrees to pay 80% of the value of those receivables to Bell Homes immediately. The bank keeps 20% as a fee. Bell Homes has applied the second type of transfer allowed in IFRS 9 and has met all the requirements of IFRS 9 para 3.2.5. Bell Homes can now recognize an extra $2 million of cash and recognize $0.5 million bank fee expense. In addition, Bell Homes derecognizes half of its receivables. Bell Homes now has $3 million in the bank and $2.5 million worth of receivables. To recap, a financial asset is derecognized either when the cash flows expire or are transferred. A transfer can be for a fixed amount, a portion, or a portion of a fixed amount. For a transfer to qualify for derecognition, only collected cash flows must be transferred. The transferor must not be able to sell or pledge the transfer cash flows to anyone else, and the transferor must remit collected cash flows to the transferee without material delay. Finally, the entity must have transferred substantially all the risks and rewards incidental to ownership of the financial asset.